At AIA Australia, helping your clients in their time of need is our number one priority. In 2016, we paid over $1.15 billion in claims to both retail and group members. That's over $4.5 million every working day. To offer your clients cover you can trust, chat to your AIA CDM today.
Welcome everyone to a session on property this week with Christopher Bates. We've had him on in one of our earlier sessions actually when XY Live kicked off, and he's giving us his time again today to talk about how he does property with his clients. A few things to note: we've recently in the last month just had another burst in Facebook group growth. We're over 100 people in the last month. We're up to over 920, and the activity just keeps on building in there. The Melbourne event, we're almost sold out. Bill, well done, mate. There's everyone wants to have a bit of whiskey and cigar. And what we're going to look at today is, unpack Chris's proposition to his clients. He spent a lot of time in this space. A lot of advisors are looking into property, whether it's broking or just wanting to help clients who are struggling to make the right decision around property. Chris is going to walk through how he does it, and hopefully there's going to be some things that people can take away and implement in their business. So Chris, how about we kick off and talk a bit about what your journey's been like in the last few years?
Okay, cool. Thanks for the invite, and good to be here. Loving the XY success. I guess my journey's probably been an advisor for 10 years, I'll go back, I go all the way, but 5.5 years ago, I was looking to get a new job and had a few options, and I decided to join a company called Property Planning Australia. And this really was a huge pivot for me in terms of my first 5 years as an advisor was older clients. It was 60s, 70s, 80s, a couple in their 90s. And when I joined Property Planning Australia, it completely shifted. So it went to clients in their 20s, 30s, 40s. And that kind of it moved my advice in a total other direction. I guess the reason I joined them as a business is because their proposition was a bit different to what I'd seen out there. They incorporated property. They seemed like they knew what they were doing around property. They were very confident. And I guess I didn't know anything about property. I kind of took that leap of faith. But after 2.5 years there, I kind of realized I wanted to open my own business and started my practice. And since then, I've kind of out there actively kind of saying now that I'm not working with any older clients. I say it in every meeting now that I'm not working with clients over 50. And I guess my kind of proposition is really helping young families, attack their kind of long-term, financial challenges, I guess. So yeah, that's kind of a bit about me.
And what about with I know you made a bit of a change in terms of branding in the last couple of years. What was the I guess from what I've gathered, you found a bit more purpose in what your business is about, and can you tell us a bit about that transition?
Yeah, so when you're starting a new business, you try to come up with a cool name, and so I started with Canopy Private, which really didn't mean anything. Really, it was just a name that I thought sounded good, and it kind of resonated with my love of animals, if anything. But I guess I've been moving more and more towards kind of advice around life and well-being, and kind of connecting what we do to someone's purpose. And so I needed a brand that represented that, and hence why I rebranded to Wealthful. And the kind of idea behind Wealthful is that money or wealth is whatever you want to believe it is, and that could be not just financially orientated. It could be lifestyle, it could be purpose, it could be health. So I want to expand the definition of wealth and kind of connect people with that. Hence why I decided to rebrand to Wealthful.
Nice one. And with what you're doing at the moment, what's your activity breakdown in terms of how you spend your times with clients? What sort of advice is being given? What proportion is debt? What proportion is super and insurance and things like that? Yeah,
so because it's all younger clients now, and most clients come to me via LinkedIn. So they come to me and they've usually been following for a while, and they usually come to me with a property related problem. I want to buy a first home, I want to upgrade, I want to renovate, I need to refinance a loan. And So a lot of my work is related, helping them with those decisions, helping them think through, whether they should do it or not, and if they are going to do it, how to go about it. And so then that's leading to a lot of the way I get paid is via broking. And so a big part of what I guess percentage of my business is broking. And then after that, once we've sorted out those big decisions, which they're huge decisions, we then move on to the other things. And so that might be insurance, that might be, rolling over their super, etc. So, as a percentage, broking is definitely, from a revenue point of view, a big percentage. But a lot of what I'm doing as well is mindset coaching and behavior coaching and actually educating them on what they really want out of life, which I'm not actually getting paid for that. I'm usually getting paid through other forms, I guess.
Yeah, well, for those out there that haven't seen Chris on LinkedIn, you must be living under a rock because he's probably the most successful person I've seen on LinkedIn in terms of activity and engagement. Just while we're on that, that link that you're talking about between your social media activity and its success there, how that's flowed in, how long did it take for that to take off? And
it's a long game. And I would say that some of the rewards out of that have probably only happened in the last 6 months. So last year was quite sporadic. I'd get, a couple a month, new clients from it. But now it's probably to a couple a week. So, 2.5 years I've been kind of on there. For the first year I was writing, long form articles and very financially driven. And I've just stopped doing that really. I very rarely do it now. And now it's just daily updates. So I've been consistently doing one a day, but in the last probably 3 to 6 months, I've upped it to 2 a day. And yeah, so it's a long-term game.
Mate, every time I go on LinkedIn, which is about 2 times a week, I only see your face. I'm like, this is not connecting with you because I only see you. You're posting a photo and a brief kind of right. I think
it sounds like there could be a little bit of jealousy, Phil. You're not getting those 2 leads a week from your videos.
No, not jealousy at all. I think you're killing me. I love it. But for someone who's probably not going to use your services, it's kind of like, like LinkedIn is just Chris Bates app, daily updates of Chris.
Well, we just saw they're going to allow videos. So you got any ideas around that, Chris? What you're going to be doing?
I think it's just going to flood it, and I actually not really a fan of it, to be honest. You can already see, that many videos going on there, and they're average at best. So, I'm going to be interested to see how it works. I think someone's got to do something different.
Just moving on to that LinkedIn, I think you really hit the nail on the head with LinkedIn, just posting a photo and then kind of an insightful kind of comment around that photo. How did you come out around, realizing that that's really what LinkedIn is loving? Because it seems, from my LinkedIn, it seems like that's what LinkedIn loves to show everyone.
Yeah, I mean, it has. It's recently shifted to this kind of where you post a longer form and you have to press see more. So it's like this clickbait kind of things hit in the last couple of months. I haven't been doing that, where someone would write, maybe a few hundred words. And the only way you can read those few hundred words, you've got to click more. And so they're very, very common on LinkedIn right now. But before you couldn't do that. You only had to and so if you just wrote something, then it would kind of get lost. So the picture basically is what stops them. And then if the picture resonates, and then I guess if you flick through LinkedIn, you can very quickly see why something's not getting liked or something's not, getting shared. It's either not personal enough, it's not well articulated, it's not interesting, it's self-promotion, it's what everyone else is writing. It has to be unique. It has to be something that resonates and is authentic to you. And so I guess that's kind of my philosophy on it, I guess.
Well, it sounds like we'll need to do another session on LinkedIn in a few months, I think.
Yeah.
All day about it.
And to be honest, Chris, I've seen quite a few other people, I'm going to say that they're just copying you. I've seen other people in my networks go, look at what Chris is doing, seeing he's killing it, and just kind of doing the similar thing, which is great,
Oh, every idea comes from somewhere, so no one's unique. So,
yeah, exactly.
Yeah, cool.
Yeah, well, yeah, you're doing a great job, mate. Keep it
Thanks,
up.
appreciate it.
So let's bring it back to property. So you get a client in and you're walking through the behaviour piece, the sort of dreams, the aspirations piece, and 100% of the time you end up at property. Is that how it works?
Well, I mean, to be honest, the biggest challenge, young clients, is their family home, right? So I work in mainly Sydney and Melbourne, and we're after a boom. And so, they've got to make a decision on that. If you're looking at pieces in their puzzle for their life, where they're going to live long-term is a huge piece. It's the biggest piece, Are we going to rent long-term, or especially if you're pre-kids or you've got kids, that security around your home, whether you're in a home now and you need to renovate it, or whether you need to upgrade, or getting a solution for that is the first thing I think every advisor needs to consider, because, that's their biggest, if they know they're going to live in an area and they've got a house and it's already paid off, and then we can move to where to from here. But if they haven't got over that hurdle yet, it's just going to be something that's constantly in their mind. And secondly, how can you advise someone what to do with their savings or to put more money into super if they haven't got this biggest question answered? So, a lot of the time it's talking them through that from a lifestyle point of view, and, getting them we're getting to a bit of a crossroads, I think, now, where people are basically having to really consider, can they actually get a home that's big enough, that's actually going to suit their lifestyle and give them a life that they want long-term in Sydney or Melbourne, without going into enormous debt, and then leading to having to earn a very high income and then to save a lot of money to kind of support that life. I think a lot of the time it's talking that through, and then trying to come up with, different ways to cut the pie. If that's not possible, then do they look at, rent vesting, and getting comfortable with that? I guess property does lead itself to younger clients as a better asset class, just purely down to leverage. If you've got 150 grand, you can go buy $1 million worth of property, but, you're not going to leverage that 6 times into the share market. You'd be feeling, you'd struggle to do it twice. And so, that's kind of, and especially not only leverage today, but it's future leverage. So if you buy a property and it goes up in value, you can then redraw on that equity, and then you can go buy your shares, But if your shares double, you can't then go back to the bank and then just kind of say, well, now I want to, reborrow against them. It's such a long-term play. And so, I think that's why, generally speaking, when you're younger, it makes a lot more sense to look at property.
Are there any particular trends that you're seeing in terms of how young people are reacting to the high prices and sort of out-of-the-box ideas that you're working through with them?
Yeah, I think hotspotting and investment property magazines and all this, and trying to pick the next hot market in property, it doesn't work like that. And, you can throw all your eggs into one property, which you're usually doing. And if that doesn't work out, then, you're taking extreme risk. So that's something that I'm seeing. I'm seeing people take punts on new property and things like that. And it's another example of what, you shouldn't be doing. So I think the biggest trend is people are stretching and they're buying their future home today. So, even if you are 30, you're trying to buy a house that you're going to move into when you're 40, and you're going to rent it out for 5 or 10 years. And you're going to get comfortable renting on a lower income today. So you're buying a home that you want to live in 2028 or 2023, but you're buying it in 2017 or 2018. Mm-hmm. And you're negatively gearing it for 6 or 8 years or whatever. So, that's a good solution, I guess. That's one kind of option.
Yeah, interesting. So with this process, so like we've gotten to the property stage. How do you help them decide? What's the framework you go through? What are the sort of steps that you walk through with them?
Okay, so my clients are generally, a family, and they're usually on double incomes. And when you add up those double incomes, we're talking $200,000 to $500,000 usually. So, their borrowing capacity isn't really an issue. So they can usually go borrow, a couple of $1 million without any problems. their challenge is usually savings. So, have they got the savings or the equity to allow them to actually purchase good assets? And to buy good assets is expensive. So, if someone comes to me and they've got $50,000 or $70,000 and they're looking to buy a house $1 million, it's just, my advice is to keep saving, but if they come to me and they've got, $300,000-$400,000, then we start to consider, well, what sort of asset do we lead towards? Do we look to buy a future home? Do we spend money on renovating? So there's not a kind of a cookie cutter approach, but the philosophy is always, can you afford to get quality assets? And if you can't, either consider looking at other investing or look at saving more, or super and things like that. And so, the process is a kind of 15-minute phone call, and I'm getting better and better at kind of, only letting, I guess, the clients that can really help go through. And that's leading to better outcomes. And then I guess 60-90-minute meeting where we discuss life and all their biggest challenges, and then we kind of map out what we need to do from there.
Do you have any key filter questions in that 15-minute phone call?
They have to be past the initial kind of, I want to save and I've got $30,000. They have to probably, be really trying to take it seriously. So when someone's trying to park the meeting and they're moving it, and they've kind of got it's probably more of a behavioral, emotional. I mean, a new client yesterday, they've got $50,000, but he's an architect, the wife's an interior designer. They're probably not going to be a client yet, but in 5 years' time, they've got all the right behaviors, they've got the right attitude, they're smart. So I'm happy to sit down with them for, 60, 90 minutes and just get them on the right path. But they might not turn into a long-term, a short-term client, but mentally they're the right type of client. So, that's what vice versa. A new client this morning, he sends a text message and it's more of a like throwing mud at the wall philosophy. Can you help me with this loan? I really want a quick deal, and they kind of expecting you to work miracles. When I speak to him on the phone, he's not really to take responsibility and to really, and so, I'm not going to really invest a lot into that, but I'm going to invest a lot into the other guy.
And what kind of things are you doing in the meantime? So they may be a client in 5 years' time. Are you doing anything with them in the meantime, or just staying connected?
I did go down that cash flow route, and I did, use some software, and I did try to I just didn't like being dad, I guess, and telling someone, just not to save money or to save money. I want to push the ball into their court and go, it's up to you really. If you really want to take this seriously, you can do it. I give them a system, I give them a process, and I just say, look, this is how I do it, and this is how I think the best way to run it is. And then it's up to them if they want to go and implement and actually save.
Just to get into more details, when you say you give them a system, is it just more like, here's my framework, take it and work it how you do it? Or
yeah, I just give it away, my cash flow system, and just say, this is how I do it, this is how I recommend you should do it, and if you want to do it, this is how I would do it. And rather than, I don't really believe in the kind of the app thing. I kind of looked at it all, and I just don't. I think it's more of a behavioural kind of system that you need to have, and stop the way you're currently doing it and start again, and then structure it this way. So
sounds like it could be a referral opportunity, Chris.
Yeah, I just don't want to get there. Yeah, I just don't want to get into the cash flow, and yeah, that's kind of my view on it. I think if you're serious enough, you don't need someone to tell you to save. It's a behavioural spending thing. That's my view, anyway.
Yeah, that's fine. So, you've gone through that process with them. That's someone that's committed to buying a property. Now what?
So, if they've got the housing, their family home issue sorted, and they're on top of their debt. So I built my own calculator to figure out what's too much debt for someone. And I take them through that process and explain, look, the bank wants you to pay it off over 30 years, and that's $4,000 a month. But the bank wants you to pay it off over 30 years so they can make a lot of interest off you. Secondly, if you get interest rate rises or you don't earn as much money in the future, you're only going to, feel stressed about this minimum repayment. So if you can only afford, $4,000 a month, you've got way too much debt. You need to be saving $5,000, $6,000, $7,000, $8,000 a month. So I go them through what I believe they need to be saving per month to actually pay off their mortgage. And so I walk them through that. If that's comfortable and they're on top of their debt and they've got equity, We then kind of consider, well, how much equity have they actually got? And, if they've got a lot, if they've got little, like 50, 100 grand, I don't consider that a lot of equity. I think that's just a small buffer. You've only got to send a small decrease to their house value, and then that equity gets blown out. So if they've got $3, $4, $5, $6, $7, $800,000 of equity, now we're starting to talk through and go, well, why don't we use some of that equity to work for you? And depending on their borrowing capacity, we start saying, well, now you've got the equity, you've got the incomes, you've got the serviceability, you can go borrow $1 million. And so if you can afford $1 million, we then start thinking, what would be an actual quality asset to get? What drives the property market, and what sort of assets should you be looking for? And so then you're looking at something to get something with small, like a limited supply, is the first thing, and that's usually housing. And the problem with housing, though, it's cost a lot of money in the capital cities. So then we start talking through, well, how does the property market in capital, you know what I mean? So then we start going into detail of what drives the property market. And if they're going to spend $1 million, what type of asset should they look for? And then we go through that process.
So with those metrics, I'm curious about the filter metrics, because I think I guess especially if off the back end of debt, in terms of doing a loan, obviously that's how people get paid, and there's that. Arguably, there's a bit of conflict. Like, I'm a mortgage broker as well, and you're sort of there going, well, we've got to, like, I don't get paid if the loan doesn't go through, but then you've got the client on the other hand, and mortgage brokers don't have best interest duty, but we're advisors, obviously, and the way you go about it is being an advisor. What are those metrics that you put in place? Because I know a lot of people sort of struggle to, how do you actually, where do you draw the line?
So I think fundamentally, if you are worried about getting paid, I think you're already losing, because that's not a way of approaching it. You need to disconnect yourself from the outcome of whatever the advice is, the best advice. So I guess that's the first thing, is you need to mentally do that. You need to mentally just be committed to giving the best advice.
So, Chris, I'll just challenge you on that.
Yeah.
Oh, here we go.
That's an easy assumption to say, disconnect the outcome to the advice. But fundamentally, with mortgage broking, and the outcome is how you get paid. So how do you do that?
It's an inbuilt thing that you've got to kind of, so it's like, if a client comes to me and they say they want to buy an off the plan unit, I would say, look, I'm not going to support. I would educate them on why I do not believe in that, why I think that's a stupid idea, and why they should consider alternative options. And if I lose them as a client, I lose them as a client. I would not feel comfortable doing that. If they've signed a contract on it, I've even asked clients to, really reconsider whether they should even go through and buy that property. And so I would, and if I lose clients from that, which you very rarely do, because they're going to value that advice, then, that's kind of the fundamental thing. If a client has got a borrowing capacity of $300,000 and they've got $50,000 in the bank, I would say, I don't believe you can go get a quality property. If they start saying, well, I can go get something up in Townsville, or I can buy a DHS property or something like that, I would go say, I wouldn't do it, and I don't want, and so I wouldn't have that as a client, because I just don't fundamentally believe in that's the right thing that they should do. And so I just really challenge the client on making sure that they're not just doing something because they feel like they should do it, or they've been told to do it, or something like that. And, so I know that every single property that every single client's bought, I'm supporting. I know I've lost clients from that. I know I have, where they've wanted to do something and I'm not going to be the facilitator for it because I don't believe in the asset they're buying.
Yeah, so you draw a line on the assets, but what about those metrics around is it a good idea to actually purchase something? So you said you don't believe in the 30-year, I guess, affordability piece. Do you bring that? Do you say how much would they need to pay per month to pay it off over 10 years or 20 years?
Yeah, exactly. So I call it 0 to 10. I think if you can save like X amount per month and pay your loan off in 0 to 10 years, you're smashing it. You're taking off way too little, a manageable debt. You don't have to stress about it. If you can save $10,000 a month and you take out a mortgage for, $800,000, you've got nothing to worry about. If it's going to take you 10 to 15 years, I think you're still quite comfortable. Bearing in mind the bank says 30. If it's 15 to 20, I call that uncomfortable. And anything over 20, I think you're taking way too long. And I just wouldn't do it. And so it's this 15 years is kind of my magic number. This is something that I've just kind of, I educate my clients on. And that spits out an amount per month. And if they can't save that amount per month, I really challenge whether they should be doing it or not. And so, because you're just going to hamstring yourself. You're just going to have this huge debt over your head. If there's any correction in any kind of reduction in the property price, or your income doesn't rise like you think it's going to rise, you're going to find it very difficult to get ahead by building equity. So that's kind of my philosophy.
Yeah. So, Chris, how does that play out when you see a client? Do they, most people will probably do a borrowing capacity calculator before they might come and see you, or some people will. So they'll know how much debt they can take on, and then they start looking at properties around that figure. How do you then go, actually, let's dial that down? Do you have the conversation of going, reduce the the property price and therefore move further out, or smaller property? Or do you do the strategy you were talking about before, saying, hey, let's buy that 10-year house and rent vest? How do you manage that expectation from the clients?
So they need 17% at least. So I don't do loans over 90%. I just don't believe in it. I think if you've only got enough savings just to cover 8% deposit, you pay a ridiculous mortgage insurance, and then also you've got no buffer. So, so firstly, they need the savings to get the 17%, and then also, they want to get a quality asset. So, if they're borrowing capacity, it's all about just getting quality assets. So, if they have got their housing issue sorted, if they haven't got their housing issue sorted, we've got to consider, do we buy our future home today, or do we buy our first home? So you've got to get through that hurdle. If you're through that, then it's basically saying, look, if you've only got a borrowing capacity of 500 grand, I think you're really going to struggle to get a quality property. But if you've got a borrowing capacity of $1 million, you're going to struggle to get a good house in Melbourne. It's going to get, I believe, and at the current market, but you might be able to pick up a house in Brisbane for $750. But then you've got to understand the challenges of investing in Brisbane compared to Sydney, Melbourne, and how it's a complete different market. So, that's kind of the philosophy behind it. Is it's I guess helping them understand that to get good assets, you need a lot of borrowing capacity. I don't believe in picking up $300,000 properties and getting a portfolio of $3.5 million over 12 properties. It just doesn't work like that. It's just you're buying lower quality. Yes, you've got more quantity, but you're buying lower quality, and lower quality have got higher risks, and will get less and lesser returns long term.
So on those, in terms of the selection, what about Domicom and BrickX? Have you had a good look at them?
Yep. So,
just for anyone listening, Domicom and BrickX are sort of broken down ways to get exposure to property. They both do it a little bit differently, and Chris might sort of give a bit of a breakdown on
Yep. So a bit of disclosure, I actually arranged all the loans for BrickX, so I'm the broker for BrickX, but that's to explain that. But it's not something that, so that's just something there. But in terms of an actual new way of investing, BrickX is actually buying quality property. So they're actually buying houses, they're buying low unit blocks in quality suburbs. And so from a long-term investment point of view, if you do what you need to do with property and invest long-term, and long-term is not 5 years, it's 30, 40 years, you're going to get good results because you're buying quality property, and so etc. Domicom's more of a collective kind of, you put all your money together, and the way that would really work is if you're buying quality assets, and you need to really question whether what you're buying there is a quality asset or not. Because property investing only works if you get quality assets. So Domicom can work if you get together with 5 or 10 investors and you go out and buy an amazing commercial property and it's got a great yield and it does really well. Yep, maybe. And then there's other ones popping up, like there's Covesta and there's a few others that will keep coming. Fractional property investing will be a way of the future, purely down to able to get diversification over many properties very simply and save all the times about trying to get asset selection. And Property Partner in the UK, I think it's got over 200 properties now. So if you can imagine the BrickX platform with 200 properties all over the country, you could build a portfolio of $1 million over 20 properties, 50 grand in each. And so no matter what's happening in Australia, you could have, $1 million and protect yourself in case there is a shutdown to the mining boom in Perth, or the Adelaide doesn't take off, or, etc. So, but it comes down to quality assets.
Do you see them making their way, because I know my understanding is BrickX is a unitised vehicle, so like a managed fund. Do you see them making their way onto wrap platforms?
I think they definitely should. The challenge they've got is they've got individual assets. They've got, the problem they've got is the individual assets, right? So to actually you have to get individual properties onto the platform. So where it actually changes though is when you've got an index. And so you've got properties of 100 properties and you can buy BrickX as an index. That's when...
The liquidity and Bob's your uncle. There you go.
So
you can see that happening for sure. Yeah, because I think people, the attachment to property would extend into super as well if people had the opportunity to.
I don't think whether you should put in, you've got most, there's $7 trillion in property or something like that, and there's $2 trillion in super, so property outside on its own asset class is huge, so, and most people's wealth is already tied to the property market. And so then pumping your super with property, you can see there's going to be problems here. So, leveraging up in super to buy, which is, I get, almost weekly from clients asking to leverage their super fund up into property. It's not a good idea to be putting everything into property.
So you look at it as hedging of your bets sort of thing.
Yeah, definitely.
Yeah. So with property, like the licensee structure that we deal with in Australia can often be quite challenging around and very, scare a lot of advisors away from doing anything in the property space. How do you navigate that, and what are your suggestions for people who want to explore a bit but don't want to step on any compliance people's toes?
Yeah, so the first thing to remember is that the property market is unregulated, right? So when you go out there and you want to help people with the property market, you got to realize that when they go out to the property market and try to help themselves, is they go into an unregulated environment and they get absolutely sold to. So you need to make sure as an advisor, you're not the one who's getting sold to as well, because there's hundreds and hundreds of different companies exist out there, and they partner with advisors, they partner with accountants, and they sell the accountant and they sell the advisor because they pretend that they're the expert, and they then get the advisor and the accountant to refer to their business, and this is your direct property solution, and that then funnels the client into buying new property. So the first advice I would say, any advisor, do not fall for it. Do not fall for new property and partnering with these organizations. And that's and even worse, don't ever take a kickback. So if you want to refer to a buyer's agent, never take a kickback. Never take anything. As soon as you do, you start tying yourself to organizations. You've got to stay completely independent from the property decision. So if you want to help people with property, don't partner with any organizations and secondly, don't even partner with individual buyer's agents. Stay independent. Have multiple buyer's agents. So if you're introducing a buyer's agent, introduce 3. Introduce multiple options to them, because buyer's agents by themselves, are only going to be experts in certain suburbs at certain points, and to narrow someone's search down to what that one buyer's agent's doing is being a little bit ignorant that they can't be across the whole property market. So they need to get varied opinions for different suburbs and different states. So when you get into the asset selection, that's where it's going to come back and bite you. If you've said, you referred to this company, that company invested in a house and land packages in the growth corridor of Brisbane or something nonsense, and then that doesn't go up or that goes back in value, the client's going to come all the way back to you and say, you told me to do that because you introduced me to this company.
Yeah, I totally agree, Chris. I refer to buyer's agents, and I went out because I wasn't doing it, and it's a massive, asset for clients, and lots of my clients are asking about it. So I went out and met probably 15 buyer's agents,
Perfect.
knocked a whole bunch back and said I would never go near them myself, so I'm never going to send a client to them. And just had a panel of different buyer's agents that I refer my clients to. Totally agree. And kickbacks is it's kind of a no-brainer. Just it's not that hard.
It is a no-brainer, but it still happens every day. It's pretty scary what's happening.
But let's just go back to that licensee issue, because you talk a lot about quality assets for clients. So you obviously go into discussion with your clients about, what makes up a good house, what makes up a bad house, what is, in your definition, a quality property. How do you manage the licensee arrangement around, is this all, because imagine the general versus personal advice is very muddy in that space that you're talking about.
Yeah, so I'll never talk about suburbs. I'll never talk about streets. I'll never talk about, I'll give feedback, but the feedback I give is from a high level. It's okay, you want to buy 40Ks from the city, and I'll educate them on how a ripple effects works with growth and how it goes the other way. If they want to buy an off-the-plan unit, or I'll explain them how oversupply and how the investor market drives that market and how that's taking a risk. So I just educate them on a risk management point of view and talk to them about kind of from a demographics point of view and growth and things like that, how to reduce the risk. So all the property kind of solution that I'm talking about are very kind of low risk, low supply, high demand properties. And that's what I kind of drum in. And then I say, look, I'm not going to be the expert in terms of selecting properties. You need to use a buyer's agent for that. And then I educate them on how a buyer's agent works. And after using a buyer's agent, multiple times and seeing client outcomes, you can really kind of understand how they add value. And I educate them on why they should use a buyer's agent. And so that's kind of from a licensee point of view, I cut myself at the asset selection. Say, look, this is not my cup of tea. And then I end it there.
Yeah. And I mean, using a buyer's agent is kind of a no-brainer. Saying, hey, you're coming to me for advice and you want to buy your biggest asset, why wouldn't you get advice? It's kind of an easy win for that referral from an advisor. We've got some people watching on Facebook Live who have got some questions, and we've got some people live in Zoom. I don't know. But Dylan has asked, he asked a while ago, Chris, I see you're big on exploring values with clients. How do your conversations take place around helping clients understand when there's a conflict between their goals they come to you with and the values that you uncover? That's question one. I think this is so valuable, and doing it more and more with younger families. So Dylan's doing a lot of this work. So how do you manage? Clients got you're uncovering values, but they say they want something different. How do you manage that process?
I mean, I guess it's being authentic and being real in the conversation to give yourself the right to ask that question firstly. So, you've got to, I guess, understand what's really driving them. And I guess if they're wanting, a house and they're saying that they want to work less or something like that, you've got to then really say, well, this is really, you really challenge them that they do this. This is actually going to have consequences on their income. And so you actually then go and say, is that really going to give you the flexibility to, you know what I mean? So I guess if the values are, or whether it's even working. So there's a client who I've got as a CFO, he was working, he says he's a family man, but he wasn't being a family man, right? So, I guess, I think I've got the right to help him to question whether he should even be doing what he's doing, because he's not getting ahead. He's got a stupid mortgage, he's stressed, etc. So, I think that's where it comes to. I think you kind of, to actually go in and question someone, I think you've got to get the right to know that they've got your best interest, you've got their best interest at heart. So I think it's not something you can easily just pop into the first question, I think, if, they're living their life and it's nothing to do with their values. Does that make sense?
Yeah.
Yeah, because it's quite a personal thing.
Yeah, and more, I know I'm dealing with it, and just being upfront and saying, look, my value to you is just to be candid, and I'm generally relatively good at that, and just kind of being open and candid with clients and just going, look, if I don't think you're doing the right thing, I'll let you know. And yeah, that family man piece is kind of big. That's
I say something very, very, very similar. I just say, look, the way I'll give advice is that it's always, it's quite sometimes blunt. It can be upfront. It's sometimes not what you want to hear, and but it's always coming from the right place. And so I would say something like that on the phone, and and when I am in meetings, if they're doing something that I don't agree with, or they've bought properties that aren't good, I'll always just tell them, and I'll just explain. But I'll explain why I think what they've done isn't a good decision for them long term, and I'll highlight risks and things like that, knowing that when they go home, they go, no one's really told me that before. No one's really said what I'm doing is wrong. And after a while, that'll sink in, and then they'll understand it more, and they'll come back to you, and they'll respect you so much more.
So we've got another question from Lee Smith. He says, how are you finding being both financial planner and mortgage broker? So how do you keep up to date with both hats, and what are the difficulties with it?
Oh, it's not easy at all. I would say that I was working with brokers for the first 18 months before I decided to become a broker. So I was doing joint meetings with brokers, and I'll admit this, that I thought it would be easier than it is. And I thought, well, I was generating a lot of business so these joint meetings, I was generating a lot of business for him. I was like, well, why don't I just do this? I can actually add a lot of value here. I actually enjoy the conversation. Why don't I just become a broker? And it's not that simple. And I think it's been a journey. I think I've got to a position now where I've got my process with mortgages and understanding banks and complexity and credit, and I can not waste time, so I can be much more efficient with broking, which means that I can then actually now extend my knowledge. So I think I've had to get my education from here to here when I actually thought it was a lot easier. So it hasn't been an easy journey, and it's not, especially with mortgages, it's a constantly ever changing beast. And the planning side, I just keep my advice really simple. So, I don't go in, I don't believe in building investment portfolios anymore. I believe in kind of index funds. I believe in focusing on, your behaviors and things like that. So I don't go out for coffees with, fund managers anymore or anything like that. I just cut all that out, and I just stick to what I believe in. I just don't get surrounded with the noise. Does that make sense?
Yeah.
Yeah. And so that's kind of how so keeping up to date with the planning side, obviously all the legislation and things like that, you can do it. It's just, I don't get a lot of time wasted in advice is probably around technology, which I've been guilty of, and investments. And so I just don't get dragged there as much anymore.
And the strategies, I guess, are just not as complex with younger clients. They just really aren't. Unless you've got someone with huge amounts of income that you may need to do some, contributions and stuff, it's just really not that complex. It's pretty simple.
And that's a key reason why I stopped working with older clients as well. Is because I was in this, my headspace is like this, and then I have to do this. And then it's the time to actually build that advice and actually get, and everything that goes with it, it's just not worthwhile doing. So I've just made that business call, is that I'm only going to work with younger clients, and then I'll just nail all the strategies there and become the expert in that.
Yeah. So Dylan's also asked another thing, just thoughts on buyer's agent value to buyers. Just give us some more info. So quick, I'll give you 1 minute because we are quickly running out of time. What is the real value for a buyer to use a buyer's agent?
It comes on many, many different levels. Fundamentally, in a hot market, in a cold market, they can get something that and they negotiate and things like that. In a hot market, everyone knows it's a good property. So the key is actually getting access to that property, either pre-market or off-market, which a buyer's agent's got a better chance than any other puncher on the street. And secondly, when they find that property, getting the actual deal done and actually getting a signed contract is extremely difficult, because you've got an overinflated vendor who wants an X price and a buyer's agent who wants to pay this, and the real estate agent has to get that deal done. And so a buyer's agent, is a little bit of a secret hidden club that no buyer's agents and no real estate will talk about. But behind the scenes, deals are getting done because buyer's agents and real estate agents are making deals. And the average punch on the street doesn't get access to making those deals. And so the buyer's agent's scratching the real estate's back and vice versa. And that's just because they're both independent from the transaction. And so if you're going to talk about the value, even just for that, getting the deal done, it's extremely valuable. There's good property. Everyone knows what a good property is. And there's 15 people trying to buy it. So how do you become the one? And the only way you become the one is getting someone to actually do you a favour. And they do favours to buyer's agents, not to punters.
Yeah. And they know buyer's agents are going to come back. They know buyer's agents are legit. If they say this is what I'm going to pay, then there's no mucking around there.
That's so true. So if you're a real estate agent and you don't know who's the real buyer, you've got dreamers, you've got people who are, all sorts of stuff, and you don't know who the real buyers are. But if you've got a buyer's agent who you've dealt with before, they've got a pre-approved customer and they'll get the deal done. So if you're a real estate agent, you're going to do preference to a buyer's agent because they're going to get the deal done. And so that's kind of how it works.
Yeah. So just last question. Who's your dealer group or licensee, Chris?
Madison.
Cool.
Nice one. Chris, epic session, mate. I think a lot of people got value out of it. A few highlights. If anyone's trying to get into LinkedIn and figure out how to do it well, just copy what Chris is doing. Property
exactly.
camping.
Just copy exactly.
Pretty much copy and paste, yeah. You can do property as an advisor and you can do it well and you can keep it compliant. I guess is one key takeout. And then the other thing is buyers agents add value. Like that last bit I think was really good because a lot of advisors, as Dylan was asking, umming and ahhing about the value. They don't have much experience with dealing with these guys. By the sounds of it, both your experience and Phil's experience, it's definitely a good idea to shop around and do a bit of research around who you deal with there.
Yeah.
So, mate, thanks for your time.
Appreciate
shout
it.
out to AIA for sponsoring the session. Thanks for partnering with us. And see everyone in the Facebook group. Good times ahead.
Thanks, guys. Appreciate it. Cheers. See you. Bye.